We tend to think of financial crises as these huge, sudden shocks that just come out of nowhere. One minute everything's fine, the next, total panic in the headlines. But what if I told you they're not so sudden? What if there are always warning signs, signals that things are getting fragile way before they actually break? Well, today, we're going to learn how to read those signs.
And that quote really gets to the heart of it, doesn't it? The source material for this whole explainer makes this one crucial point. Crises build up over time. They have a rhythm, a kind of pattern. All these different economic variables, they start moving together, sometimes quietly, building up pressure. And other times they're screaming that a panic is coming. The real trick is learning to see that pattern before it's too late.
So, how in the world do we do that? Well, let's think of it like an economic dashboard. It's just like the one in your car, right? You've got gauges for your speed, your fuel, your engine temp. They all tell you if you're running smoothly or if you're about to have a problem. In the world of finance, we have almost the exact same thing for economic health. And if you learn how to read them, you can spot the warning signs long before the engine seizes up. Okay, so let's pop the hood and get into it. We're going to walk through the 7 key gauges on our economic dashboard, one by one. We'll figure out what they measure, and more importantly, what it looks like when that needle starts creeping into the red zone. First up, the exchange rate. Now, this isn't just some number you check before a vacation. It's an incredibly powerful price that reflects a country's risk, its credibility with investors all over the world, and the difference in interest rates. It's basically a real-time poll happening 24/7 on the health of an entire economy. So the crucial thing here is to watch for specific red flags. When you see a currency making huge moves in just one direction, like only down, it's a massive signal that big investors are all sprinting for the exit at the same time. And if that's happening, while it's also getting harder and harder to actually make trades, what we call thinning liquidity, that's a huge warning sign. I mean, think about it like trying to sell your house during a panic. If suddenly there are almost no buyers, you've got to slash your price just to get out, right? That's what thinning liquidity is, and it means the whole system is getting brittle. All right, let's move to our next gauge, interest rates. The best way to think about these is like the force of gravity pulling on an economy. They set the cost of borrowing for literally everyone, from families with mortgages to huge corporations. A big red flag here is when a central bank starts hiking rates really, really fast. That can put enormous stress on anyone with debt. Another one to watch for is a sudden jump in long-term rates, which can cause absolutely massive losses for banks and funds holding government bonds. Next up, we're going to group gauges 3 and 4 together. Okay, high inflation paired with a currency that's getting weaker, that is a classic textbook recipe for disaster. It shoves a central bank into a terrible choice. Either you hike rates and probably cause a recession, or you let inflation just spiral completely out of control. At the same time, you have to watch a country's external accounts. This tells you if it's living within its means or if it's relying on a bunch of unstable foreign money to pay its bills. Now, for a really, really critical one, debt structure. See, it's not just about how much a country owes. The really important part is how it owes that money. Who owns the debt? Is it in the local currency or a foreign one? And how soon does it need to be paid back? This is where some of the biggest and scariest vulnerabilities can hide, right there in plain sight. And this right here perfectly illustrates the biggest danger of them all. It's sometimes called original sin. This happens when a government or a company borrows in a foreign currency, like US dollars, but all of its income is in its own local currency. So if their local currency suddenly crashes, guess what? Their debt burden explodes overnight, sometimes doubling or tripling, even if they didn't borrow a single extra dollar. It is an absolutely deadly trap.
Our final gauges are all about the financial system's circulatory system. Banking health is obviously crucial, and in our digital world, you have to remember that bank runs are lightning fast now. Money can disappear with just the click of a button, and we also watch market stress gauges, like the VIX index. People often call this the market's price of fear. It measures how much chaos and volatility traders are expecting. When that thing spikes, it's a crystal clear signal that panic is spreading and nobody wants to take any risk.
So we've looked at all the individual gauges. But here's the thing. A crisis is rarely just one gauge blinking red. It's about how all these different problems start to connect and feed off each other. So let's take a look at how things go from a flashing red light to a full-on system-wide meltdown. A currency crisis usually follows this pretty clear 4-step domino effect. So, step 1. It all starts with some kind of shock, maybe a political surprise or a sudden jump in inflation. Step 2, that shock gets investors nervous and they start selling the currency. Step 3, now the central bank is stuck with that impossible choice you talked about. Do they try to defend the currency or just let it fall? And then step 4, if they let it fall, it kicks off a vicious feedback loop, making foreign debt way more expensive and pushing inflation even higher. It just spirals.
Now, what's really helpful about this slide is how it breaks down the two main kinds of financial runs. A banking crisis is a liquidity problem. It's a sudden panic where everyone wants their cash back right now. A sovereign debt crisis, on the other hand, is a solvency problem. That's when investors start to seriously doubt if a government can pay its bills in the long run. So one is a mad dash for the exits, the other is this slow, dawning, awful realization that the math just doesn't work anymore.
And the most destructive, absolutely ugliest pattern of all is when these two combine into what we call a twin crisis. A currency collapse hammers the banks that have debt in dollars. Then those weak banks stop lending money, which craters the economy, which of course makes even more money flee the country. It's a downward spiral that is incredibly, incredibly difficult to escape.
All right, so that's all the theory. But how does this dashboard actually work in the real world? Let's apply our framework to a couple of situations happening right now and see what the gauges are telling us. So if we look at Japan, that exchange rate gauge is definitely flashing. The yen's been getting weaker and weaker, and it's really testing the government's credibility. The things to watch there are the interest rate differences with the US and whether market volatility starts to pick up. Now for Mexico, the story is all about something called the carry trade. That's just when investors borrow money cheap in a place like Japan and invest it where rates are high like Mexico and just pocket the difference. It looks pretty stable for now, but the whole thing is super sensitive to global risk. A shock somewhere else in the world could make those trades unwind terrifyingly fast.
And this really brings us to a huge warning from places like the IMF. Don't think for a second that this is just a problem for smaller economies. Even the biggest, most liquid markets on the planet can become fragile. All those structural issues we've talked about, like those currency mismatches hiding on balance sheets, can turn what looks like just normal volatility into a full-blown crisis the moment a real shock hits.
So what's the point of all this? Look, the goal isn't to perfectly predict the future, because, let's be honest, no one can. The goal is to shift from prediction to preparation. It's all about building your judgment so that you're not caught completely off guard when those dashboard lights start flashing.
So here are the key things to pack in your toolkit. First, remember that crises are all about the feedback loops. It's how the gauges interact that really matters. Second, you have to look past the headlines and watch the underlying structure, especially for those hidden risks like currency mismatches. And finally, the best decisions always come from thinking through different possible scenarios, not from trying to find one single perfect forecast. And that leaves us with one final critical question to think about. A falling currency can sometimes just be a healthy, normal economic adjustment. But now, with the tools from this dashboard, you can ask the right question. At what point do those feedback loops kick in? At what point does a simple adjustment start to feed on itself and turn into an actual crisis? The answer is right there, in the gauges we've just explored.